a lot of people think that finding deals is the hard part. When you're a capital raiser, it's not as much because I've built my network big enough to where there's there's enough deal flow that I'm not concerned about, but I don't jump on every deal that comes to me. I'm being very tailored and choosing. Like last year, I only did 3 deals, and I don't know how many I'll do this year. But um, yeah, I think finding more investors, the deeper investor base I can have, the more opportunities I can likely bring. Because at some point, I realize I don't think I'm going to be able to raise enough for this deal, so I'm not going to jump in. And it could be a really great deal.
Hi, Adam Gower here, founder of gowercrowd.com and host of this YouTube podcast show, The Allocator, where I am exploring the world of, or the new world of what I call the capital allocator, even though it seems that there is a lot of terminology and a lot of language that is used, much of it borrowed from the world of real estate that I'm used to, the institutional world, that it has very different meanings. And you're going to hear some of those terms in my conversation with today's guest, Flint Jamison of, I'll go to my notes over here, Vestus Capital. Now, Flint comes out, we didn't talk about his background, oh my goodness, at all. So if you do want to know, he and I joked about this actually afterwards, but if you do want to know about Flint and what he does, find him on another podcast, because what he used to do and his background, because what he and I talked about today is exclusively what he does today. And he describes a structure for some deals that he worked on that is extremely interesting. So you're going to be hearing about that right now and hearing me stumble around as I try and figure out what the structure is. But I think we get to it in the end. If you've not already done so, do please sign up for or subscribe to my newsletters. Or you can get to the subscription page on my website, gowercrowd.com. Just hit the subscribe button. And I am discussing lessons learned, my lessons learned from a long career in commercial real estate investment and finance, with a view to using those lessons to make good decisions on making some investments personally, myself this year. So if you want to come along for the journey and join me on that, do please as well. There's all kinds of other cool stuff like AI tips and tactics and stuff that I do and have learned that you'll also find helpful, and a bunch of our podcasts and all kinds of stuff. Okay, all that at gowercrowd.com. All right, I'm going to stop talking and hand it over now to my guest, my conversation with my guest, Flint Jamison, Vestus Capital, coming right up. Flint, it's nice to meet you. Oh my goodness, I see you on LinkedIn all the time, and so it's such a nice thing to meet people. I like it. It sounds kind of wacky in the Zoom world, but I do like to say it's nice to meet people in person, right? Even though,
yeah. It's wild. Right? I mean, we do this all the time, even with conferences, real estate conferences. All of a sudden, these people we've talked to for years online or show up in person. It's great. It's like you already know each other.
It's true. Isn't that amazing how that works? Exactly. When my kids went back to school, they were online for 2 years, right? During the pandemic. Yeah. And so I asked them when they went back IRL, which was one of their terms, in real life. Never heard of this. This was something they concocted with all of their generation. Their biggest surprise was how tall everybody had become. Suddenly,
oh, that's interesting. Yeah, 2 years of not seeing people.
Yeah, right? All they saw was head and shoulders, and then they met them in person. Oh my goodness, what happened to you? Kind of thing. All right. Anyway, so this season, this podcast series is actually my 7th. It's focused on the capital allocator. I know that's something you do. So I have some pointed questions for you. So as I did say at the beginning, if you wish to dismiss them summarily, feel free. No embarrassment or shame in doing that. But let's start with this.
Yeah.
You are a capital allocator. How do you make money?
So, and I want to correct, I'm not 100% capital allocator. I mean, yes, every deal, any sponsor, co-sponsors involved in, tries to raise capital. But yes, I do asset management on the side. So there's more role than just raising capital, and I want people to be clear about that. Yes, I do have fund of funds. In that case, I am absolutely a capital allocator. So in
So
multiple
why did you
ways to
make
make
that
money.
point? Let's start right there. So you made the point that
Yeah.
you do asset management on the side. Why is that
Well,
important that people understand that?
yeah. Well, so there's two things here. It depends on the deal that I get into, the amount of um, responsibility I carry in that deal. Like if I do a fund to fund, I don't have any responsibility in the deal. I just have responsibility to my investors. Yes, I communicate to the operators. Yes, I could potentially have more say because I wrote a big check to them. But in large part, I'm not in the day-to-day business. On other ones, I am in the day-to-day business where every week I'm talking directly to the property management. So and there's also two things to this. One is from an SEC standpoint, you have to have you have to be doing substantive work. You can't just be 100% capital raiser. Otherwise, you would be considered a broker dealer
But wait a
collecting
minute,
a
you have to
commission.
okay, so let's be really clear. You have to do substantive work.
Yep,
Why?
whatever that is.
To do what? What is just connect the dots. You have to do substantive work. I do substantive work. What
Well,
does that
and
mean in the context of capital raising?
so this is where the terminology in the SEC guidelines are a bit vague, but they do. And now this has been a while since I looked at it, but um, they don't want people to be 100% capital raiser and essentially collecting a commission and walking away. So substantive, and it has to go beyond. And I believe the SEC language says, and it can't just be investor relations, can't just be talking to the investors. You have to be doing something a little more. You could be doing accounting, you could do underwriting, you can do marketing, you could do uh, market research. I mean, there's so many things you can do to check that box. You can be
That
present.
box, but what does it allow you to do to check that box? Does that allow you to collect a commission on money that you raise?
No, nope, you can't put that word commission in there unless you have the series, whatever, 65 to be a broker dealer. So
Okay.
it's not a commission. You are earning your fees, whether it's an acquisition fee or asset management fee, capital allocation fee, and then getting ownership on the GP side as well.
And how are those fees calculated then? And let's focus on
All over the map.
yeah. So give me
All
some
over the map.
so let's give me some
So
actual
yeah.
examples of stuff that you work on because it's
I
all
would
about you, this
say
podcast.
I would say that the typical acquisition fee is about 3%
3%. Okay,
of the equity raised.
okay. So how does that work exactly?
So you essentially raise. So let's say
Give
you
me
need to
actually
bring
give me an
in.
actual example, right?
Yeah,
I mean, this is
I
what
don't
you're
have all
doing.
these numbers pulled up. An actual example would be, say we need to raise $10 million,
Okay.
and you have a team of 8 people. So and everyone's raising, and everyone brings in a certain amount of money. But in the beginning, this is where we also got to be careful. You can't do pro rata fee share and uh, equity splits. It can't be pro rata, even though that's typically where things land. And so it gets dicey there. Really, what you should do to play it safe with the SEC is out of the gate with the 8 people, say this is the percent of effort you're putting in, and we have our underwriting models have a tab with this in there, and we say you're the acquisitions guy, you're going to get 20% of the equity. The asset manager is going to get 30%, whatever. You break it all the way down to who owns how much of the general partnership pie.
Okay.
And out of that, you raise $10 million. That 3% gets then divided up typically by a separate chart of who's bringing in how much money. And then also there's the people with that who acquire the deal get a share of that. So every single deal is absolutely different.
Hmm.
There's some rules of thumb, and without me pulling up going just off the top of my head, I'm not going to be able to give you all the numbers because all of them are slightly different.
Okay.
But
Yeah,
yeah,
just generalities are fine.
yeah. And then there's a asset management fee, which about 3%. I mean, you're looking at 2 to 4%. 4%'s a bit high.
Hmm.
Normally, if it's a bit high, you're looking at a more distressed asset where there's a lot more work being put into it. So you can request for higher asset management fees. There's a capital fee where if you're doing a refi or a sale, typically there's a 1% fee in that. And then acquisition asset management.
What's the
Yeah,
acquisition fee typically?
that's about 3%
Oh,
of the capital
acquisition fee,
raise.
3%.
Yeah.
Okay. Acquisition fee is a percentage of the amount of money raised.
Yes.
Okay. And then there's a refi or sale. What's that? That's 1%. What's that?
That's 1%. It's think of it like what real estate agents charge, except it's not 3%, it's 1%. So it's 1% of the sale.
Okay. And so I kind of want to position you in this
Yeah.
and how this works. So you have what, and I'm gonna say what I think happens.
Yeah.
You tell me if I'm accurate.
Okay.
So, right. So for example, you've got this medical thing that you're working.
Yeah.
Oh, you want to, actually, before we do, let me step back to one other thing that you mentioned. Fund of funds. So what is a fund of funds? And you said in that case, you don't have actual active roles. So
Yeah.
what is a fund of funds?
Yeah. So perfect example, 2022, we acquire there's a primary fund is partnering with three experienced operators, three assets, two states, three different cities. So we have Houston, Tucson, and Phoenix.
Three sponsors. So
Three
different
sponsors, three
sponsors.
different sponsors, three
Okay.
different assets. Uh, one was and three different asset classes really. One was brand new off the developer, Class A, super beautiful. One was a Class B renovation, value add. Another one was a Class C to Class B renovation.
These are all multifamily.
All multifamily,
Multifamily. Okay.
all reside in what we call like a $30 million fund. It was a $30 million equity raise.
Okay.
So the primary fund partnered directly with these properties or these operators. They were the KP, so they played way more of a role than just handing them
KP.
a check. Key
KP.
principal.
Key principal. Okay.
So they were the ones who found the loan and signed on the loan.
Okay.
So not only were they writing a big equity check, but they were also writing their name on the loan, signing their signature there.
Okay.
So, and they are very active with the operators. They have their own asset management team that goes to each one of these assets and works in lockstep with the operators as well.
Okay, what's an operator? When you talked about a key principal, what's the difference between the KP and an operator?
So when we say operator, that's the actual team that did all the work to find the asset, did all the underwriting, LOI, get the PSA, did all the due diligence, basically get the package wrapped up. Now, a lot of operators don't have or may not have the financial ability to acquire a certain asset. Like they've already done 3 deals and their investors are tapped out. They need help. Or, hey, we're scaling. We're used to doing 50-unit apartments. We're going to do 100-unit now. And I don't have the deep enough pockets for lenders to get that loan. So I bring in a key principal who has the deep pockets, who can sign on that loan, has the deep pocket, not only the deep pockets, the liquidity, the net worth, and the experience. That's what a key principal is. And so that key principal essentially gets GP shares because they're the ones that can sign on the loan and they bring their experience and or net worth to the table.
Okay.
So
So in this case, so in this example you're giving me, there's three sponsors.
Yep.
Three different areas, all multifamily, different kinds of multifamily,
Yeah.
three different cities, three different sponsors,
Yeah.
and all of them, how did they all coalesce around this one key principle?
So yeah, these now this is where so these each one of these operators, they're doing their own thing. The big money comes in. This big fund says, "Hey, we want to build a portfolio of three different properties over three different operators. Build a diversified multifamily portfolio,
Okay.
different operators, different assets, different cities." And they say, "Hey, can we partner with you?" And they timed it just right. They already pre-vetted over a year's time or more the networking with these operators. They had certain criteria. They had to have so many exits. They had to be operating for so long, right? And they said, "Okay, we want to partner with you." And they're like, "Sweet, you got money. You can bring good lending to us." So not the operator themselves also raised. They brought in their own equity, but they also got one big check from the primary fund. So
Okay.
that's kind of how it works.
Okay. So let me,
So yeah, yeah,
yeah,
we
let's,
got to
let
take
me
it to
just say
another
it
level
back.
too.
What's that?
Yeah, then we got to take it to the next level so
We
people
do.
can.
But before we take it to the next, let me just clarify what I think you just said. So you are involved in a fund of funds
Yep,
where somebody that is you've called a key principal spent time identifying sponsors over a period of time,
yep,
cut deals of some sort with those sponsors, and we'll get to that in
yep,
a minute, created a fund, and that fund, the idea of that fund is to go out and raise enough money to satisfy the terms of the agreement that KP has with
yep,
those three sponsors. So let's just assume, for
yeah,
argument's sake, it's $30 million raise. If you have and can remember the exact numbers or closer to the exact numbers, that's fine. But if you can't, we can assume, just for
yep,
the time being, 10 million each. So each one of those sponsors needed 10 million of equity for an aggregate 30 million. And this key principle set up a fund to provide that money to them. Let's stop there.
yeah.
Let me ask you
Okay.
one question before we go to level
Yeah,
two.
yeah,
What how did the key principal presumably had conversations with these sponsors and said,
yeah,
"Hey, we'll bring you the 10 million that you need each, this aggregate 30 million. But in return, and just correct me if I'm wrong, my guess is if that is exactly right. If
yeah.
it's not, let me know.
Okay.
In return for bringing you these big checks, you will give us preferential terms, correct?"
Correct.
Yes. Okay,
That's
good.
it.
And so what do those preferential terms look like? Again, if you can remember the specific,
So
let me
I
know.
don't I don't know what those so I'm the fund of fund. I'm one layer down. So whatever they negotiated is irrelevant to me.
You don't know what the terms are that
I
they
don't know
have
what
with the
with
sponsor.
the operators. Correct.
Okay.
So the 30 million fund now, I had been networking and was coached. They were they were my coaches.
The
So
KP.
the KP was also educational in the multifamily space.
Okay.
And
Is it a secret who they are? Who your
well,
KP
I'm
is?
not going to uh I don't know that I want to mention it on a podcast.
Okay. No problem.
They're big though. I mean, they've raised hundreds of millions. So
Okay.
um me working with them teaching me, as a newbie, they said, "Hey, Flint, we got this $30 million fund. You could bring in a fund to fund and write us a check for." And this is where they had, I think they had five different classes. Now this is going back to 22. So they had
Okay.
five different classes of investors. Your minimum investor is a $50,000 min, and they get 70-30 split with a, I don't know, 7 pref or something,
Okay.
with a waterfall on the back end. So their top end was a $5 million check. That could have been like a 90-10 split with a 9 pref. Like I don't remember the numbers, but you get it. You just, the bigger the check you write, the more pref you get. So as a fund of fund, I want to hit a higher target, like at least a million, because I need enough beneficial split from the primary fund in order to be able to pay for my fund to fund expenses and pay for my effort in it, and give my investors at minimum the same 70-30 split, 7 pref at a $50,000 investment.
So how does that work if you're passing through those economics all the way to your investors? How do you make money?
So that's what I said. There's skimming off the top. So if I get a 90-10 split with a certain level of pref, but I get what I call it the capital transaction fee. I can't call it an acquisition fee because I'm not actually acquiring a property. I call it a capital transaction fee. So I raise, say, $1 million, and I write that $1 million check to the primary fund. If I want a 2% acquisition fee, I think that's what I charged. I need to raise extra 2% if I want to write an exact $1 million check to them. I also need to cover expenses because now I'm responsible for all of the taxes and K1s for my investors. So
Okay.
in essence, I'm running my own private placement security with investors, and I'm responsible for all the accounting, bookkeeping, and taxes. So there's expenses there that I also have to cover.
So inside this kind of master fund,
Yeah.
you also have your own fund.
Yep. And my fund
Yeah.
goes into the master fund as an
Right.
LP.
Okay, got it. Right. And so how many investors in your fund and how much did you raise for that $30
So
million?
that one, we raised 1.25.
What, 1.25 million. Okay.
Yeah.
And so in return for that, you got you landed in one of those five
Yes.
classes.
Yep.
So so one of your investors looking at the sponsor, and do your investors know who the sponsors are exactly?
Yes. They
They do.
even know who the operators are.
Oh, even the operator. Okay.
Yeah,
So
yeah.
I use the term sponsor and operator
Yeah, and those
interchangeably.
yeah, and most of us do, but once you get into the fund to fund structures, all of a sudden you have the property operators and then you have like the fund sponsor. And so yeah, you kind of need to
There's a lot
be
of
specific.
that's right. Yes, the language starts to get a bit blurred,
Yeah.
doesn't it? All
Yeah.
right. So okay. So that I think of the sponsor as the person who is the person actually on the ground doing the deal, right?
Yeah, yeah, yeah.
Whoever is. This is how I
Typically,
determine this.
typically, yes.
Okay. The sponsor is, in my view, the person, or define it as the person who decided what terms to agree
Yep.
with the master. Uh, what did you call it? The master
Fund,
fund.
the
Yeah.
primary
So
fund,
whoever
and then the
made that
master.
decision, they're the sponsor. That's the person who says,
Yeah.
"Well, I'm going to give you this." All right, sort of thing. So let's say that their deal. You described three different deals here.
Yep.
Let's say that their deal was offering a 70-30, 8 pref to a 70-30, right? So 70 over an 8. The master fund now comes in and negotiates better terms for the master fund and then creates 5 different layers of
Yep.
investors inside that and goes out to guys like you and says, hey, do you want to invest here? And presumably there is a delta between any one of those 5 levels
Yeah.
and the terms that the master fund gets with those sponsors. So they're making money they're making a delta, and then
Yep.
you're making a delta as well. Is that correct?
Yeah, yeah. And so the primary fund does get a preferential return from the operator for the big checks. And you're right. So let's say the primary fund, they can probably only afford so many big checks with taking uh, that bigger split, like a 90-10 split. They're not going to make as much money, but it's a lot less work to get that big check. But they also want to limit the amount they can bring in at that level. So you even see that at just property deals. Hey, we're going to give preferential to 500K investors, but they're only going to open it up to so much. Or like a pref equity position,
Mm.
they typically limit it. So that's all done on the back end where they limit how
So
many people get to
so
touch
in
them.
that 30 million, how many people like you were there? Capital allocators.
Um, 7 that I know of. I don't, I mean, I didn't get to, I just know the people that were involved because they're peers. There could
Okay.
have been more. I mean, that wasn't a question that I was like, hey, I got to make sure somebody else doesn't write a check to you guys.
Okay, so the
But
master
yeah,
fund has at least seven other funds feeding into it.
yeah.
And of that 1.25, again, you don't have to answer
Well,
these
I
questions.
guess I guess to be more clear, I had people who joined me under a
Mm,
single subscription doc or private because I had co-sponsor friends, and there's no sense in all of us going out and spending $5,000, $8,000 on legal docs when we can all essentially co-sponsor within our fund of funds. So I had multiple people in mind, and I know that there was another fund of fund at minimum. So I would say total 6 of us, but some of us piled into one fund of fund.
And how many actual investors, how many people wrote checks out of your 1.25?
In my fund of fund, something like 19.
Okay. And do you co-invest in these as well yourself?
Yeah, I try to. Yeah, I always say I try to because at some point I do have liquidity challenges myself. And if I had to wait until I had enough liquidity to invest in a deal, it would take me a long time to even get to the next deal. So yeah, I put in a little where I can. Like if the minimum's 50, sometimes I'll scrounge up 25 and throw it in there. But sometimes I'm not able to. Just
And your investors, so you've been reticent to share with me on the podcast um,
yeah,
the master fund,
master fund,
people
right?
in the master fund. Do your investors know who that is?
Yeah, they do.
And and on these three deals, how have they been performing? When did you close this, Flint?
That was in 2022.
So
So that was kind of in the peak of things going bad.
right. So how are they doing?
So those properties, one of them was the small 52 unit. Um, that was a major uplift from a class C to a B. So
Okay.
it was known not to perform until it finally got overhauled. It did finally get overhauled. Took a little bit longer, but now we're cruising. So that one's good. Another one, oddly enough, had a developer create a copy of, I think it's 240 units right across the street. So it was screaming. It was a cash cow, even with interest rates going up. It was doing awesome. And then a developer finished another copy of an apartment building, new dev, and all of a sudden it became a supply problem. And then,
So
or a
in
demand
short, that
problem.
one's not doing too well.
No, now it's fine. That other property is finally back, but that hurt for a while, right? To fill 242 units across the street with all the comps that developers do, it was painful. But now it's doing okay. Um, and then the third one is interesting. So in Houston, there's a tax abatement strategy. Like you can work with the Houston HFA or HHA, Houston Housing Authority. Anyway, you can work with the Houston government and get a tax abatement where you agree to terms of a rent restriction and not pay property taxes. So that one, the Class A, in the world of interest rates increasing, became challenging because Class A's have less margin on the top. You're running skinnier margins, and right now we're in the process of putting a tax abatement in place to reduce that expense. Then we'll be cash flow really healthy, and it also boosts our NOI. So yeah, we're kind of in the middle of that right now. So
Okay.
it's all over the map.
All right, good. I got some quick questions after. I'm going to
Yeah,
ask you to reflect on
yeah,
that in a minute. But so so the criteria that your master fund manager, again, I'm
yeah.
using terms that I hope make sense to you
That's
because I'm
fine.
not sure
Yep.
what terms you use. But when your master fund manager went out and find sponsors, you mentioned criteria. What were the criteria and what are the criteria that you like to see in a sponsor? Sponsor being the person who
Um,
decides how much to allocate of their GP position to you. That's what I mean.
um, well, so allocation versus criteria of choosing operator are two totally different things. But
Yeah,
I'm missing your
I'm
question.
just defining what I mean. The role is I call a sponsor, right?
Yeah,
The
yeah,
decision maker who's actually running the deal.
the apartment operator. Yeah,
Yeah.
yep.
So what criteria do you look for? What criteria
So
did this master?
they
Yeah.
the primary fund had criteria. They told me at the time this was 2022, so I don't remember it, but it was so many exits. It was a certain level of performance. Um, so they had a pretty strict criteria.
Hmm.
Said I don't remember what it all was, but they did share it.
What are your criteria?
So my criteria, and this is where it gets interesting. Yes, I want operators to have at least 5 exits now. It didn't start out that way when I was younger and newbie in it.
Okay.
But
How long should they have been
caveat
in
to
the
that,
business? 5 exits over what period of, well, like how long should they be? Like minimum
um,
years of
it's
experience.
it gets really hard finding operators that have been in the industry for more than 15 years because those who've been in it more than 15 years are much bigger operators and they don't need your money. So unless I can write really big checks. So I typically am in the 10 to 15 year range. Some of these operators, though, they've been in real estate for 20, 30 years, but they've just started doing multifamily in the last 10 to 15.
Okay.
So there's a lot of gray area here. You got to just, I think if you have hardline numbers, you can overlook people that are capable. Like this medical real estate
Mm.
portfolio, much different. He hasn't been in the medical real estate directly. He owns his own portfolio, but he hasn't done any exits and he hasn't sold a portfolio to a REIT. However, he has built a business managing dentist offices, like being a consultant to 100 million revenue a year business, then selling to private equity. Now he's turning around and buying the dentist office buildings and not running the business within. He's an expert in triple net lease. He's an expert in underwriting dentist offices. So 75% of the effort in doing due diligence is doing due diligence on the business that's living within your building. And then the last quarter for a dental office under triple net is underwriting for the building itself. So you
Flint,
gotta,
so you just segued really
I
nicely.
did.
Something
Yeah.
completely different. So what's this? You got a health fund. I did notice. So let me ask
Yeah.
you, is it the same general policy? Not to discuss names
Well,
but that on
yeah.
your website, the team page for your medical thing has no names. It's got pictures, but no names.
No,
Any
no. In the
reason for
presentations and
that?
the video, you'll absolutely see who it is.
Oh, okay. I'm just curious because I
No,
went
it's
on your
that's it's
website and there's no names there, and I thought, oh, that's
no,
curious.
it's
I've never
yeah. You
seen
got to
that one.
click in. That you landed at the landing page. You got to go into the info, get the info.
Okay.
So it's all there, and you'll actually see the main guy. He has two different videos. One's just like a 20-minute overview of here's the deal, and then the other
Mm.
one is a deep dive due diligence for those who want to geek out on a spreadsheet with him. But the reason I segued is because we were originally talking, Clint, what are your standards for finding an operator?
Mm.
Well, this operator doesn't have 10, 15 years of owning medical office buildings. He absolutely has those years of experience running the businesses for dentists, managing the triple net leases with the landlords. He knows the business for a long time. So that's why I don't really have hard and fast rules
But
because
how did
I
you, so
could.
how is this one different from the fund of funds with these $30 million three
So
sponsor
yeah,
multifamily?
yeah. So this one I'm co-sponsor. Jumped in. I am directly co-sponsor with him. Now he's got a full-time staff of 2, 3 people that help him run his business. And then there's several of us that are playing capital allocators slash we will have to perform substantive work once we finally close on these properties and start operating them.
Okay. And that's so you start as capital allocators and but then you have some kind of substantive role to
Yeah.
make sure you meet SEC regulations,
Yep.
essentially. Yeah.
Yeah.
So how many capital allocators are there in this one? And what's the
Uh,
total raise for that?
Five. This one's kind of small. So we did our first tranche at 4 million. We just closed on that one. And we'll do another tranche about 4 to 6 million to get another 4 to 6 offices. At that point, we'll have a portfolio of 8 to 10 offices. In about 3 years' time, this portfolio will operate with 10 million NOI a year, and that's when we become very interesting to REITs.
How many allocators are involved in this one then at this initial stage?
No, there's no. I mean, there's
Well, how many people are
private
raising
house.
capital? Let me put it
Yeah,
up.
yeah,
That
all
4
of
million.
us. So there's at least 7 of us.
Okay. All right, so let me ask you something kind of unrelated. Well, it's actually directly related. So you're out there trying to raise capital from accredited investors, etc.
Yeah,
And you've been to doing some training, you've been to some, conferences, I've no doubt.
yeah,
And you know that there are a lot of people out there doing the same thing.
yeah.
How do you compete with those people? How do you make yourself stand out when you're raising capital from individuals that may have seen dozens of other people trying to do the same thing?
Yeah, it's my looks. That's all it is.
You count on your good looks. That's what I
My
do
curly
as well.
hair.
We're in the same
Yeah.
boat. I said so I have an accent as well, so I
Yeah.
kind of
You
lean
got
on
me one
that
up
a bit.
there. Yeah, it's funny because I technically have a lot of competitors, but the majority of my competitors are my friends because they're my peers. And a lot of times we partner with each other, and I've partnered with my peers multiple times. So yeah, some of these peers, there's one that's a lawyer, there's one that's a retired surgeon. These guys are all chasing different people than me. I'm an engineer. I built
Right.
airplanes, aerospace engineer. So I speak an engineering language, and that's I speak to the tech world and engineering world. So I kind of target a different group,
Mm.
and and I do my best.
That's really cool, and I'm really glad that you said that because actually I've been talking to a lot of allocators. Don't mind me using that term, just
Yeah, that's
a
fine.
general term, right? Capital
Yeah,
raise, and a lot of people don't really know what their unique value prop is and what their
yeah,
unique language is when they talk to people. I mean, they have it. Everybody has it, right?
yeah. It's just
Everybody
finding
is
what it is.
unique. But what I've seen happening, Flint, is a lot of people, the vast majority, tend to go to conferences and go to these kind of mass trainings and come away with templates and then
Mm.
use those templates and then just copy and paste those templates and then bung them into AI and say, give me 20 versions of this. And then they use that. So actually, everybody sounds the same.
Yeah, yeah,
And in order to raise money effectively, and this is what I do with my clients, you've really got to put forward your unique value proposition. And when you do that, you attract people who
yep,
relate to you, right? You
yep,
can't use templated jargon or junk and
yeah,
just copy and paste it because it might seem like it's a good idea, but especially when everybody's doing it, it's just noisy and you just become
yeah.
part of the cog. All right, so let's move towards some final sign-off questions. By the way, I do have one final
Yeah.
question before my
Yeah.
final.
Okay. Okay.
Uh, your website
Yeah.
has a some numbers here.
Okay.
One says 2,338 plus multifamily units, $225 million portfolio value, 5 years of experience. What do those numbers mean exactly?
Yeah. They're half vanity numbers because I mean,
So is the
yeah,
portfolio that you own worth 225 million?
no, that's the value of the properties that my collective investors have invested in. That is not the equity raised. That is just like that three-pack portfolio is worth 100 million, right?
Okay.
So yeah,
So you
it's
raised
some of it's a vanity.
1.25, you raised 1.25 million. That's 100 million of
Yeah, whatever that number
portfolio
is. Yeah.
value. And then how much have you raised total doing what you're doing now?
I think I'm just shy of 10 million.
Okay. And how many total investors?
Hmm.
Approximately.
Yeah, 60 to 70.
670. Okay. 10 million, 670 investors.
Yeah.
And then that the portfolios that those have invested in are worth 225 million, at least on paper.
Yeah. Yeah.
Right.
Yeah, on paper.
Right. That
When
100
we bought
million, you
them.
think it's really worth 100 million actually?
Well, yeah, it's like when did you buy it and what the market do? So because I just took purchase value.
Okay.
Yeah.
All right. So let me ask some sign-off questions.
Yeah.
Rapid fire sign-off questions. You've been in this for 5 years. Oh, by the way, just as a side note, it's super cool that you said you built airplanes.
Yeah.
That is exactly what my father did. My father was a mechanical engineer,
Yeah.
and
That's what I
he
was.
he built planes for what was called
Okay.
AV So this was the precursor to it wasn't British Airways, it was called something else. British Air, maybe
Okay.
precursor. And yeah, so he built yeah, he worked at AV Row, it was called, and once a year he would go to the Avro 504 Club reunion. And they were all getting older and older and older. It was always a
Yeah.
Friday night, I remember. He would always stay at home for Friday nights with the family, but once a year, he'd toddle off
Yeah.
and go and join these guys. And he always came back with they had like a menu or something. I've got them in a box somewhere. And everyone signed on them, cheers, Ivan. And, they'd write and they'd all pass these things around. And it was really cool. He described some of the things, but this was really old days. I think they pedaled on takeoff when my dad, he
I was
designed
gonna ask you,
that.
do you know what the airplane was
Do I
that
know?
he
Yeah,
worked
I
on?
think he worked on Spitfires and
Oh, no way.
yeah, World War II stuff. Yeah, yeah.
Oh, that's awesome.
One of the planes he worked on delivered what he called the bouncing bomb. The bouncing bomb.
Hmm.
The
I
bouncing
have
bomb
seen
was
those.
it was a dam buster, and then
Yeah.
I guess the way it worked was that it span. It
Yeah.
span. If you drop a bomb on, in those days, I don't know these days. You've got whatever laser AI pointed, God knows robotic stuff, but in those days they wanted to blow up the dams. And if you dropped a bomb, they couldn't figure out how to do it, couldn't get in close enough. And so they figured out a way, because every dam has a body of water. So they
Yeah.
created this round bomb, I think. I mean, I'm pulling this from,
Yeah.
when I was in my single year age, my dad would talk about.
Yeah.
And it span. So the planes could come in, drop this thing, and it skipped across the water until it hit the dam, and it's what they call them, dam busters. And so he worked on the planes, and I guess it was really technical and stuff. In the
Wow.
Yeah, a long time ago.
Yeah, I have seen video of that old black and white video of those.
Yeah. Well, I'll tell you what, I'll try and dig some stuff. I'll have to go into some dusty boxes and see what I can pull out. You might find it interesting.
All
Anyway,
right.
so anyway, it resonates. It's really cool that you did that.
Yeah. Yeah.
5 sign-off questions.
Okay.
Flint, what has been the hardest lesson you have learned so far in real estate?
Um, I learned a couple hard lessons out of the gate. I mean, I bought my first duplex in 2018. That one is a wild story. But I think when it came to one of my first syndicated deals, we we thought if we built it, they would come. And we found an asset and I was going to be the primary operator and we didn't have investors lined up already, so we figured, oh, hopefully they'll come, and they didn't, among some other things. But we ended up backing out of that deal. So
So the
uh,
lesson learned is it's not so easy to raise capital.
it's not easy to raise capital. No,
Okay.
it's a grind.
All right. So what have you found to be actually the best way to find active investors? I mean, this is a marketing guy asking. What's been the best method for you?
Yeah, to be honest, LinkedIn has been my path for the most. I do really like in-person networking.
Hmm.
Just, but it's harder to find individuals who are looking. You can go to conferences and stuff, but a lot of people at conferences are their mindset isn't, oh, I'm looking to invest in real estate. Or if you mention you're investing in real estate, they're like, oh, cool, that's neat. And then they go off and do their own thing. So in person though, if you get the people with the right mindset, I think those are the ones that convert the easiest. But in large part, my database is largely built on people that find me on LinkedIn.
Isn't that amazing? Oh my goodness. I'm so happy you said that. I run a LinkedIn mastermind, and you're not the only person that has said that. In fact, that is a common theme.
Yeah.
LinkedIn is the best platform for finding investors. Flint, what are the biggest challenges you face today? Apart from answering my questions.
Uh, Finding more investors. Yeah,
Ah,
what's interesting is
mm,
a lot of people think that finding deals is the hard part. When you're a capital raiser, it's not as much because I've built my network big enough to where there's there's enough deal flow that I'm not concerned about, but I don't jump on every deal that comes to me. I'm being very tailored and choosing. Like last year, I only did 3 deals, and I don't know how many I'll do this year. But um, yeah, I think finding more investors, the deeper investor base I can have, the more opportunities I can likely bring. Because at some point, I realize I don't think I'm going to be able to raise enough for this deal, so I'm not going to jump in. And it could be a really great deal. I think that's my biggest hurdle.
what's the biggest misconceptions about, again, I'm just going to use this term kind of generically, the capital allocator model, the fund of funds model that you're
Yeah.
describing. What's the biggest misconception you think there is about this sector of the real estate business?
Um, I don't know that I come across too many misconceptions. Not even in the fund of funds, it's all just describing what it is, and my investors seem to grasp it well enough. I think the biggest misconception, even when I started syndicating, to just newbie investors that are like, wait, I can invest $50,000 into a commercial real estate deal through this thing and just sign a piece of paper. Is that, and they're like, is this a pyramid scheme? Or, yeah, I've had the pyramid scheme question, I've had the Ponzi scheme question, and I think these are just like knee-jerk reactions because they've never heard of it before. These are totally newbies who've only focused on their 401k and their Fidelity, who are now like, wait, this is a thing? And then all of a sudden they start raising red flags, Ponzi scheme, that scams. And so that's really the misconceptions that I get.
Last question. Advice to somebody thinking of doing what you're doing as a capital allocator. What would be the advice you would give somebody thinking about doing it?
Don't do it. No.
Why? You've had enough,
No.
not too much competition. Bugger off.
Yeah, we don't need more. Um,
Seriously, seriously.
I think it's
Mm,
people don't realize how hard it is, especially if you're not. I mean, I know some people that come out of sales and marketing themselves and are that's what their career has been. So stepping into this is not as big of a move versus me, aerospace engineer, never done sales and marketing. All of a sudden, I'm in a world that I don't know. I can run a $120 million program modifying aircraft for Air Force, which is what I did right before this. Sales and marketing is a different animal. So I had to re-educate myself. So my suggestion to anyone wanting to get in, you got to get educated. You got to know how to underwrite. You got to know how to evaluate deals, and then you got to find what specific player you want to be. If you want to be an asset manager, you better go find an asset manager coach or capital raiser coach, sales coach. You got to dive deep on one thing that you want to do.
is that the advice you'd give yourself? You say you've been in it how long?
Yeah,
5 years?
I think I
Don't do
really
it.
started down this road in 2019. I got in my first syndication in 22. So I spent a long time educating myself. And yes, what I
No,
did
what I meant
learn,
was, if you could go back to before you started syndicating,
yeah, okay.
would you give yourself the advice, don't do it, get another,
Um,
like do
no,
trade
no,
options instead?
I, yeah. Uh, I no, I'm happy with the decisions I've made.
Mm.
There's been a lot of curveballs that have made me question whether I timed everything right. I mean, obviously, 22 interest rate hikes, that's timing to get into the industry. It's like jumping into real estate in 2008. Um, but I think the advice I would give, well, the advice I do give is you can take action sooner than you realize. Like I spent 3 years trying to learn the industry before taking action, and I was trying to learn everything. You're never going to know it all, so stop trying to be a know-it-all because you're teaming with a bunch of people who know the other things that you may not know. So one, start taking action sooner. Um, Two, don't spend $30,000 on a mentorship that's going to teach you the 101 level across the board. Go buy a book and learn the 101 level, and then go pay a coach on the very refined thing that you really want to do.
Flint Jamison, Vestus Capital. What
Yeah.
a huge pleasure meeting you, IRL, kind of. Thanks for joining me.
Thanks, Adam.
Right, that was Flint Jamison of Vestus Capital. Flint, what a pleasure meeting you. Thank you so much for fielding my hardball questions. It wasn't quite the usual podcast, I know, but I do hope that it was, well, I know actually it was extremely interesting. And I'm very grateful to you for having joined me and being such a willing guest on the show. And thank you too, dear viewers, for joining. Sure you learned something today as well. I certainly did. If you've not already done so, go to gowercrowd.com, sign up, subscribe. I keep saying sign up for. Subscribe to my newsletter. It's totally free. You can always unsubscribe. Comes out every week and covers, at the moment, it's covering the high level, actually deep dives into my experience and the lessons that I've learned throughout my lengthy career in commercial real estate, as well as some of my take on the capital allocator industry. All right. So that's it for this week. Until next time, it's Adam Gower signing off.